The following is a Silver Bullion television audiocast. Hello everyone and welcome to Silver Bullion Television SBTV. I'm your host, Patrick Vieira. With us today we have Mr. Steve St. Angelo of SRS Rocco, who is an independent researcher who started to invest in precious metals back in 2002. Later on in 2008, Steve began researching areas of the gold and silver market that curiously, the majority of the precious metals analysts have left unexplored. These areas include how energy and the following EROI, or energy returned on energy invested, stand to impact the mining industry, precious metals, paper assets, and the overall economy. Steve has written numerous articles which have been featured on many financial and precious metals websites. He also runs his own SRS Rocco report at srsroccoreport.com. Good day, Steve, and welcome to Silver Bullion Television SBTV. EROI. Steve, I'd like to start with what you are most well known for, or probably well known for. You consider studying the impacts of EROI one of the most important aspects of your energy research. For our listeners, they may not be that familiar with the concept. Could you briefly explain the concept of EROI and how does it relate to the investment analysis of gold and silver?
Yeah, Patrick, thank you. The EROI just means the energy return on an energy invested, and it's EROI. That's the abbreviation. And in a nutshell, the energy return on investment is the leading factor that will allow us, if a single cell organism, if an animal, a plant, a human, a company, a corporation, or an empire survives or dies. It has nothing to do with the profitability. It has nothing to do. Basically, if you consume more energy than you're pulling in, then the system will die. It will not survive. And what's interesting, the hunter-gatherers of, let's say, there's still a few of them in existence today, but the hunter-gatherers, which were much more efficient in getting food than we are today. Even though you'll see a tractor plowing and harvesting food for thousands of people, the hunter-gatherer would spend 1 calorie of energy and he would hunt and gather 10 calories of food. Today, it's the exact opposite. We burn 10 calories of energy to get 1 calorie of, let's say, corn on your dinner plate. And that only works because of the energy of the oil. And so when we were tapping into this oil, like the United States was in the early 1900s, the energy return on investment for the U.S. oil and gas in 1930 was 100 to 1, which means we were delivering 100 barrels of oil for the energy cost of one. Well, now shale today, even though we're producing a lot of it, Patrick, we're only putting 5 barrels of oil to the market for every 1 barrel of cost. And the problem is our society needs a much higher number. We need 12 to 15 barrels. So what's happening? We're adding all this debt to offset that. So as the energy return on investment continues to fall, it's going to cause a lot of stress on stocks, bonds, and real estate because they get their value from burning energy in the future, because we all know stocks and real estate are based upon the principle of net present value. So I think the issue is, that's why I'm a big believer in gold and silver, because their values were received from burning energy in the past. So that's why they are a store of value, where most assets are promises for future economic growth.
Why do you think the production has dropped off so greatly from 100 to 1 down to 5 to 1?
It has to do with thermodynamics. And when you start, it's like when we were hunting whales back in the 1800s. You went after the easy to get to ones first, and then as you start getting more whales, hunting more whales. You use more technology. You get bigger boats. You get, but there comes to a point where it takes so much more energy. I mean, let me give you an example. In California, one of the huge gushers in California in the 1910s, it had an energy return on invested of 30,000 to 1. The oil, the gusher was, it ran for like 6 months before they could get it under control. Now, the problem is it didn't take a lot of energy to drill a hole and get the oil out when the oil was very easy to get to. Today, it takes a lot of energy, especially when you go into deep water. I mean, these oil rigs are billions of dollars, and then they go down a mile just to get to the ocean floor. So what's happening, it takes a lot more energy, which is technology and costs to produce this oil. And so that's the reason why it continues to fall. And when it gets closer, the problem is it doesn't have to get to 1-to-1. Because we need a certain number to run our modern economy. And that number is, from the analysis I've seen, Patrick, it's over like 10 to 12 to 1. And shale oil doesn't pay the bills. That's why the shale oil industry is not making any money. It's riddled with debt, over $250 billion. But again, technology is money, right? It costs a lot more to drill a well today than it did 30 years ago. So that that cuts the ability to send that energy to the market. So unfortunately, for example, U.S. oil production doubled in 27 years from 1947 to 1970. And just with shale, it's doubled in 8 years. It's gone from 5 million barrels a day in 2000, let's say 10, to 10 million barrels a day currently. Now, anything that goes up that quick also comes down that quick. So this is the issue. We brought it on. We needed the energy, but unfortunately, we're not going to see a continuation of this high amount of U.S. oil production. And so when it starts to fall, it's going to fall quickly. And I don't believe the market is prepared for that.
You had mentioned previously about precious metals, silver and gold. The silver-gold ratio, it does continue to be rather high. I believe today it's at about 81 at this moment, indicating that silver possibly is very much so undervalued versus gold. And also, if I'm correct, we have witnessed only 4 times in the last 20 years when the silver-gold ratio was at 80 or higher. Yet the crustal abundance ratio of silver to gold is at about 19 to 1, and we have the miners who are telling us the mining ratio of silver to gold is at about 9 to 1, which indicates this big disparity between the amount of physical silver and gold and their prices. How do you view this disparity, and do you think that it's sustainable?
No, but I'll answer it differently than most of the precious metal analysts. The reason why we had a historic 10 to 15 to 1 gold to silver ratio up until recent times was due to the way it was extracted out of the ground, and that was human and animal labor. Now, when oil came on the market in the late 1800s and in the 1900s, it changed the way we extracted these metals. So the cost of production really declined. And so right now, I look at the price, the way the market is valuing gold and silver, more based on its cost of production. And according to my analysis, it's about $1,200 an ounce, $1,150, $1,200 an ounce to produce an ounce of gold. And it's about $15, $16 to produce an ounce of silver. Now, that's primary, but that's 30% of the market. So when you divide those two, you get about a 70 to 1 ratio. Now, it is 81 to 1 currently. So what changes the value of a commodity, energy, good, or service, the foundation is its cost of production. Now, when you have more supply than demand, then it will pull it below the cost of production trend line. And then when you have more demand than supply, it'll pull it above that cost of production trend line. And that's what we've seen. And so the thing is, right now, silver is unfortunately, silver is off the radar, especially since last year. it outperformed gold in 2016. In 2016, it outperformed gold. It went up much higher. But gold has gone up nicely in 2017, where silver kind of remained flat. So according to the market, silver is just off the radar. But we have to look at one other thing. The silver commercial short position is at its lows. And I think it's currently it's about 19,000 net short positions. Well, its low back in July of 2017 with gold was about 21,000. So we're below the low of last year. Gold its net short position is 190,000 contracts right now, but its low back in July of last year was 75,000. So when you get to a low, that means the price is bottoming. Now, and traders have been getting more into gold, and we're seeing that on the COT report, on the traders report. But for whatever reason, the commercial short positions are at their lows. This means to me that silver is the better value than gold. When the markets really start to crash, the stock markets, we will see a disconnect. It won't happen. It won't happen immediately, but when silver takes off, it's going to outperform gold, even though gold is outperforming silver currently, because there's actually about 1-to-1 ratio of above ground investment silver to gold in the world. And so when you look at that, when you start getting investors moving into silver, that's why it pushes its value up much more than gold.
If I can add on to that, a couple years back, there was a little bit of a silver shortage on the retail end. It was getting harder to get silver, but at the same time, silver spot price was dropping. What we had seen on the retail side were people coming into the shops expecting to buy silver at a cheap price because spot price was indicating a cheaper silver price. On the dealer side, we were having to pay more for the silver. So from that point, we did see a bit of a disconnect at that time.
Yeah, I did see that as well. And it was the premium. The premium surged because the spot price wouldn't. And you see, people ask me, well, if the silver and gold are based on the cost of production, then why would they increase in the future? And the thing is that gold and silver should be valued differently than, let's say, oil or copper or wheat or corn or lumber. Those are consumed. Gold and silver, even though they're used in industry, silver is used more in industry than gold. A lot of it is saved and invested. And so silver and gold, even though they've lost their, let's say, monetary use as money, they're still a store of value. The issue is they should be valued as a high quality store of value. But the problem is 99% of the market has been focused on putting their funds into stocks, bonds, and real estate. And since 2012, when the Fed started QE3, that's when we saw the huge disconnect. The gold and silver prices fell. The money went into stocks, bonds, and real estate, and that's where they have remained. But I can assure you, when this highly leveraged market finally starts to correct, and I believe we're going to see a crash. People think the gold and silver price are going to fall. Well, they're closer to their lows. If silver was $35, $40 and gold was, let's say, $1,800, $2,000, yes, I could see a sell-off in the precious metals. But they're already at their lows, or let's say silver is more at its lows than even gold. So I see a disconnect, and that's when I see gold and silver returning to a high-quality store of value. And that's when, you could just see a fraction of investors moving into the metals, which could push their values up extremely high.
What do you think it'll take for silver to maintain, let's say, at least a low 70, high 60 ratio? For right now, it seems that it's stuck somewhere between 77 and 80.
Yeah, and again, it's based more on its cost of production and demand as well. And investment demand has really fallen off the silver in the last few years. even though the price of silver fell in 2013, we had 2013 we had a huge increase in demand for silver because it was a they thought it was a bargain basement price. It was a steal, but as the silver prices trended lower and stayed lower, what that does it kind of keeps people uninterested. Now the cryptos came into the picture and all these huge gains in the cryptos. That's as well as the stock market and the real estate market. I mean, the real estate market, we're seeing home prices that are $100,000 more. The median home price in the United States is $100,000 higher than it was at the peak in 2007. So investors are putting their money into those assets that they see moving higher. That's the way, unfortunately, most investors seem to function. So silver trading at $16 is no one cares about it. What is going to change that, Patrick? Again, is the coming huge correction, and I see the Dow Jones falling from the current 24,000. I see it falling down to 5,000 over the next few years. That is really going to motivate investors to protect their wealth. And they're not doing it yet because there isn't enough fear in the market. But we already saw this in 2016 when a lot of investors moved into gold and silver when the Dow Jones fell 2,000 points in the first quarter of 2016. What happens when we see a 50 to 60% reduction in the Dow Jones? So that's when I see the catalyst to break this 70 to 80 to 1 trend.
You mentioned a few times real estate. In one of your recent articles on SRS Rocco, you showed some data indicating that silver is looking to be the asset with the lowest risk and best upside compared to the stock market and U.S. real estate. Despite the Federal Reserve raising interest rates steadily over the last few years, somehow the Dow Jones Industrial Average, it seems to be unstoppable, hitting new highs year after year, where on the other hand, silver, basically it's been asleep. Why are the stock markets like the Dow Jones marching higher in the last few years despite the Fed raising interest rates?
Bubbles can become insane, and you can't give any logical reason why they occur. I mean, I'm looking at a chart of Netflix here. If you look at Netflix, they continue to borrow money. They're not making any money. And their stock price in 2012 was $10, and now it's $300. And if you look at my chart in that article, watch the Dow 19,000. Watch out below. If you look at Netflix, you'll see from 2018 on, it went up from 190 to 310. The stock chart looks like the antenna on top of the Empire State Building. I mean, charts don't behave that way and stay that way. I mean, even in 1999, when we had the tech boom crash, it wasn't a bubble. It wasn't a huge increase like this. Even in 2007-8, it wasn't the same way. This one makes the prior bubbles pale in comparison. And so when you have the Dow Jones now trading at about 24,000, I believe it's a little lower today, it is still 5,000 points above its 50-month moving average, and its 200-day moving average is 13,000. You can't continue these kinds of increases in the stock prices. It can't continue. And so I think the peak is in. I think the peak of 26,000, I don't know I think it was 600. I think that peak is in. We may see a little higher pop here. Now, unless we have hyperinflation, then of course everything goes up. But if we don't have hyperinflation, I believe the Dow Jones, prices of real estate, we're going to see a 50% decline in the Dow Jones to begin with, and then it's going to go even lower. And I do see a huge crash in real estate prices because now real estate prices are even worse than the bubble in 2007. So if you have common sense that you don't want to be in assets that are closer to the highs, you want to be in assets that are closer to their lows. Silver is closer to its low, so it's low risk.
Hmm.
Most other assets are now at their highs. That's high risk. So common sense investing says you want to be in the low risk, low risk, high return asset.
Have you ever compared the situation with the Dow Jones currently with the index back in 2007 before its crash?
Well, in 2007, the Dow Jones hit 14,000, and then what's interesting, and the Dow Jones didn't fall off a cliff immediately. I did an article and showed that there were three peaks. I think 13,900, 14,100, and 13,600. It took 6 months before the Dow Jones had a continued decline. And it wasn't until 2008. So in 2007, there was 6 months of it going up and down. And then after the 6 months, it started really to decline. And it wasn't until a year and a quarter later, Patrick, did the stock market fall off a cliff. And I remember in 2009, it went down to 6,600. It fell well below its 200-month moving average. So if it falls well below its 200-month moving average, which is 13,000, it could easily it will easily hit 10,000, probably 5,000. And so when that happens, why would you want it? You start to see these asset prices falling. You want to protect your wealth. And this is what I believe in. And I'll conclude with this. People need to change their idea of trying to create wealth. I think that era is over now. We need to start working on protecting wealth. And the best way to protect it is in owning precious metals.
Right. We often hear that from a lot of our clients where they'll tell us there's a time in your life where you make money, and then there's a time in a life where you protect what you've made.
Yeah, and I totally agree with that. And the compounding interest now, or the compounding factor, is the energy. And let me say this, in 2007, when we had the crash, we had the real estate market crash because of the subprime bubble. And then we had the banking industry. I mean, Lehman Brothers has been around since the Civil War. Well, in a short period of time, it was gone. Bear Stearns, gone. We lost the investment banking industry. It's now just a commercial banking industry propped up by the Federal Reserve and the government. So the issue is, in 2007, the U.S. energy industry was still in pretty good shape. It's not in good shape now. These oil companies are saddled with debt. They didn't have that debt. For example, Continental Resources, which is one of the larger shale oil producers in the Bakken, they had about 150 million in debt in 2007, and they were paying 13 million a year to service that debt. Today, they have 6 billion in debt, and they're paying a third of $1 billion in interest payments. So unfortunately, it's worse today because not only is everything else leveraged, our energy system that runs everything is in horrible shape where it wasn't 10 years ago. So this will compound the problem when the markets start to correct and crash lower.
From what you're saying, it really does seem like the future of oil is definitely in quite a bit of jeopardy now.
Yeah, we're seeing it in Venezuela. We're seeing it in Saudi Arabia. Saudi Arabia was supposed to have one of the largest IPOs in history. Well, they just canceled it because I believe the reserves that Saudi Arabia have, official reserves, are severely overstated, and they know it. And so it's just not the United States, the rest of the world. Mexico, Pemex, their debt has ballooned. I mean, unfortunately it's a disaster. It's been a slow motion disaster, but now it's picking up speed, Patrick. And I do believe we're going to see by 2025. I think the world will be it'll be a whole different world at that point in time. And the idea of peak oil will no longer be a theory. It's going to be an actuality. And I don't know about you, but how do you run Houston or Dallas, Texas, or Chicago, or New York, or LA on 50% or 75% less of the oil? What does that look like? And what does that do to real estate prices? What does that do to the market? And I don't think anybody is considering that.
I'd have to agree. I don't think anyone's considering that. I think another part of the equation is when that oil does get to be a little bit more expensive and scarce, it's not just the U.S. that's trying to buy up that oil. We also have China that's going to be trying to buy it. We have India that's going to, they're going to be trying to buy it as well, which it's going to lead us into a global resource crisis.
Yes, and unfortunately, the oil price today is too low to fund new exploration and production. We can't grow anymore. And a perfect number is in the last 10 years, we have burned 360 billion barrels of oil, and we've replaced 110 billion barrels. So we've consumed 250 billion more barrels than we replaced. And those came from exploration decades ago. Now, we need $120, $130 oil to fund new production, new growth. And the oil...
Sorry, is that even possible anymore?
According to, if you understand thermodynamics, I don't think it is. Because we have to remember, people say, well, if a falling supply of oil, that means, and demand would increase, it would push the price up. The problem with that is, the dollar is based upon burning energy. Currencies are based upon burning energy. And if the quality of this energy now isn't worth it, or it takes so much energy to produce it, it's not worth bidding up. And that's one issue we don't understand. It's supply and demand are not the major factor for determining the price of goods, services, commodities, and energy and metals. They are smaller indicators, smaller factors. The major indicator is its cost of production. And unfortunately, the market cannot afford $120, $130. And that's why the energy companies started cutting back on capital expenditures in 2013. And the price of oil was 110 that year.
Wow.
And so we've seen a 56 to 60% decrease in capital expenditures on the major oil companies since 2013. And when they're not spending that money, they're not replacing reserves. And so I think this year will be the lowest in over 60 years since they started doing 60 years. I mean, I think last year was about 2.5 billion barrels. That's all we replaced. 2.5 billion. It's nothing compared to what we consumed. So this is the major issue, Patrick.
Yeah, I can see where all this is coming from now. You're scaring me, Steve. Got to say that.
Yeah, and you know what? I don't think people understand this information. They don't. If they understood it, they would look, because it's taken me years to finally understand it all and to put it all together. And if you understand it, you'll start to see a different future. But from the analysis I've seen, it's too little, too late, and it's not going to help offset this crash in the oil supply. And again, we got to remember, we're just-in-time inventory globally now.
Right.
Everything is transported into stores. Even the chlorine that is used in wastewater treatment for water, so we can have good drinking water, that chlorine is transported by truck. Everything depends upon the transportation system. And so I do think it's a huge issue and factor we have seriously overlooked as a society.
Average global citizen aware or unaware of these things?
They're unaware because, you see, people are looking at finance, whether it's an asset, whether it's a money market account. Everyone is concerned about assets, financial assets. The problem is finance doesn't run the economy. Finance steers the economy. Energy runs the economy. And we haven't had enough people looking at the energy. Everyone is, you put on TV, it's all about the economy, it's about the finance, it's about, profits and losses, it's about debts in derivatives. But that means nothing without the energy. And we have to remember, you've got an automobile industry, you've got a housing market, you've got a tech industry, you've got all these different industry, healthcare industry, and then we've got the energy industry. But analysts look at the energy industry the same way they look at the auto industry. But you can't produce cars without energy. Right. So the energy industry is the number one vital industry that should be really looked at in more detail. And unfortunately, it isn't. So I think people aren't focused on it. And to tell you the truth, energy bores people. So I think it's exciting because it's what makes everything tick. And so that to me that's why I always go to the energy, because it's the fundamental factor that runs the whole system.
Let's say this energy it just costs too much for a company to extract it. What happens then? I mean, I don't think we could just shut down. Our government's going to have to end up stepping in and supplementing oil companies.
They could do that. The issue is they can't change. They can print money. And they can print money, or they can try to offset the debt. The issue is the falling energy return on investment. And like, for example, the U.S. economy needs something like 12 to 15 to 1 energy return on investment of oil and gas to function. Now, we've been importing a lot of this this lower energy return on investment oil from like Saudi Arabia, but Saudi Arabia's having trouble now. Their oil, even though it's cheaper to produce than us, it's becoming much more expensive. So we need a high energy return on investment to run everything, to run the schools, to run the transportation system. All those barrels are going to run the food production and distribution system, the entertainment system. You need all those. The government can't print oil, and that's the problem. Even though they could kind of maybe offset it for a while, the debt is being used to offset this. The problem is the higher the debt goes, and that's what they would have to do, right?
Right.
If they're going to bail something out, they gotta print more money. Well, the interest expense now on the U.S. debt is it can balloon if interest rates continue to increase. So it's just catch-22. When you don't have a lot of debt, you don't have to pay a lot of interest on your debt. But now when debt is choking you to death, I mean, just for example, the top 8 oil companies, ExxonMobil, BP, Shell, Total, Petrobras, ConocoPhillips, I can go on and on. They were paying $5.7 billion in interest expense in 2013. Last year, it tripled. It's over $15 billion. So they have just lost $10 billion of profits because they gotta pay their interest expense. People who have debt now on their balance sheets that have increased. They have to service this debt. The same thing with governments. The United States is in such bad shape with their pension system, with the debt. If they increase more debt to kind of offset or bail out the energy industry, it's just going to make the situation even worse going forward. So I don't know the exact how the future will unfold, but to me, I think we're going to see a disintegration of the U.S. shale oil industry within the next 2 to 3 years, and it could be sooner. And when that happens, the idea of U.S. energy independence will be over, and we'll start to see more cracks appearing in the global oil industry. And so governments will not be able to offset this, even though they'll try.
Knowing that these things are coming up down the road, let's play a little game here on something that's very serious. If you were in charge, Steve, what would be your solution, or what would you advise us to do as nations in order to avoid these things that are coming up?
That is a hard question. And to tell you the truth, I don't have an answer. Look what happened to the ancient Roman Empire. And people say, well, this time's different. Technology is going to solve our problems. Well, they had a lot of technology during the Roman Empire. They had lots of technology, even though it's different. It wasn't as high tech as it was today. But the Roman Empire, at its peak, there was 1 million people in Rome. After the crash, after it collapsed, it was down to 12,000 people. That's a 99% crash in the population of Rome because it was dysfunctional. You didn't have people bringing food into the city. It was a disaster. The only option we have is some kind of planned degrowth. We have to. It's called degrowth. So if we could, as a mature species, get together instead of fighting with everybody and doing all these silly wars and all this petty human behavior, and we decided as a species to understand what we're facing and then possibly have some kind of structure to degrow ourselves. And very quickly, we're running out the clock here. But that's not going to happen because human beings are very selfish. So they're going to hold on to everything they have. They're going to continue what they're doing. And so what we're going to experience, Patrick, is what is known as the Seneca Cliff. And there was an ancient Roman philosopher called Lucius Seneca. And his famous saying was, growth is slow and sluggish, but the way to ruin is rapid. And as I mentioned before our interview, it's going to be like a shark fin. Things are going to fall apart very quickly. And unfortunately, there's not a lot we can do about it because we're not working together. We're all working individually, or countries are working individually. And so that's how I see it happening. Now, how it looks, how this unravels is anyone's guess. But the best options, you make the best out of the worst situation, is to be in assets that will provide you the best options when this occurs. And to me, gold and silver are the 2,000 plus years store values option that are the best options during this period.
Steve, before we wrap up, what do you think is in store for us in 2018?
I believe 2018 is the year things start to unravel. There's just way too much debt and leverage in the system. I mean, the NYSE, New York Stock Exchange, trader margin debt is over $600 billion. At the peak in 2007, it was $450 billion. In 1999, it was $400 billion. There's just too much leverage. Yeah, possibly there's a very remote chance that the Dow Jones could go to 30,000. But this is not something that we should be cheering. Cheering on an increase in a bubble isn't something that's wise. It's something that's it's very unwise. And so I think 2018 is the year things start to unravel. Now, that being said, there is this notion that my analysis, I could be wrong. I mean, you have to understand that not everybody's correct, and maybe your analysis is wrong. The only thing I believe the analysis on the energy, how I see things, it's the timing. But if I am wrong, it's the timing of it, but the timing is just a few years. So what I see happening will no longer be a question by 2025, and it will probably happen much sooner. I'll say one more thing. A lot of the precious metal analysts look at the bankers as the villain. I used to, I no longer do. Even though they're probably stealing a percentage of the wealth. If the banking industry collapsed in 2008 totally, it would have took down the whole system. It wasn't. So the thing is, the bankers allowed us to continue going to Walt Disney, to continue buying Starbucks, to get a new SUV, to drive around, buy another $1,000 iPhone. They allowed us to continue to do that. So actually, they do get some praise for that, because the other side of the equation is that it turns into a 1930s depression that we never come out of. Unfortunately, that's still going to happen. The bankers and the governments they're just holding off the inevitable. Not that I agree what they're doing, but the other side of the equation is much uglier than we can imagine. From a lot of my work, I do think the analysis is correct, and it's just a matter of time. And I don't think time is on our side. So I think there's the idea that people don't want to know the truth because it's too harming, or it's too negative. But I don't believe that. People do want to know the truth, but they're not being allowed to understand the truth. And it may not be a conspiracy. It may be just for selfish reasons for corporations to continue doing what they're doing. They want to make profits. They don't want the bad news. Bad news isn't good for business.
Steve, on behalf of the audience and myself, I'd like to really thank you for the insights and all of these amazing things that you shared with us. I don't think any of us in the gold and silver industry are really looking at energy, and especially the Seneca Cliff and shark fins. Yet somehow you've managed to tie it all together in the most brilliant way, Steve. Thank you very much.
And I appreciate your time. That's all I want to do is put out the information, and how people respond to it. If it opens up them to look into it more, I think that's a good idea. And again, my website, I put out 2 or 3 articles, the SRS Rock Report website. I put out 2 or 3 articles, and now I'm starting to do videos because it's easier to explain this using a pointer and while I'm discussing these charts. I think some of these more difficult concepts are easier to understand on my SRS Rocco YouTube channel. So your followers are more than welcome to check out any new articles, and I really do appreciate your time.
And Steve, we appreciate your time as well. Thank you. Thank you very much, Steve. For more information on his views, please visit his website, srsroccoreport.com, and his Twitter account, @SRSRoccoReport. That'll wrap up this edition of Silver Bullion Television, SBTV. Take care, everyone.